You have come to the right place. No, we have not been bought out or merged in with another firm. We're just going through a name change at the moment. We're still the same individuals you've come to know and trust. We're just putting all of our services under one roof, combining the Gunn Chamberlain and GCT Technology Group into one name, Financial Solution Advisors. So you'll see our new logo here, just combining, again, like I said, all of our services under one roof: tax and financial advising, cloud accounting, family office services, outsourced CFO services, and accounting technology. We're glad to have you with us this morning and hope that you find some of this useful. So welcome to our economic update for the third quarter of 2022. We appreciate your participation and thank you for joining us this morning. My name is Brian Hall. I'm one of the partners here at FSA and your moderator / tour guide for today's presentation. What an interesting year it has been so far. While some of the information shared in today's update may sound familiar, we hope to provide you with some new insights as you look over your portfolio. We understand that watching the headlines may make you nervous and bring lots of questions to mind. Our goal is to provide you with information to help you make sound decisions during such times, and we are honored by the trust you have placed in us. Give you a couple of the other players that are in our presentation today. My partners Kenny Cray and Don Drummond. And then we've got with us Patrick Gauthier with CPS Investment Advisors down in Lakeland. He'll be providing us with market commentary and a few more details. Kenny and Don will be talking about investing in uncertain times, what you can do to protect your financial plan and stay on course, and what changes are going on from a tax perspective. If questions come up while we go through this presentation, please drop them in the chat. We'll try to get those in the end. We've also had a couple of questions submitted in advance that we will address as well. So just kind of a table of contents. Here's what we're going through today. Our market update, again, investing in uncertain times, taxes in the IRS, which is, I'm sure all of you are looking forward to. A little bit about the student loan forgiveness. That's changing every day and every hour sometimes. And then we'll get to your questions towards the end. So now for our market update, I'm going to turn it over to our friends at CPS with Patrick Gauthier. Appreciate you coming, Patrick. The floor is yours, my friend.
Thank you, Brian and team, for having me, and everyone for joining us here this morning. Happy to bring you some insight into the market, although this year the market has not been a very exciting place to be for us as investors, but we'll hope to shine some light on it moving forward here for you. So really, the market has consisted of a couple big items this year. We have inflation. We all know that that's been the headline as far as what's affecting things. We have the Fed's reaction to that inflation. And then we have what people expect the future to be. And that's always the case with the market. A lot of it is, baked into, expectations moving forward. Your earnings estimates are always based on future earnings. So a lot of it has to do with just how people are feeling about the market over the next 6 months to the year. So certainly has been a roller coaster so far this year. We're going to take a look at a couple of things that have brought the market down a little bit so far year to date. So really, when we take a look at just what the major indices did this quarter alone, this is what we would call a classic bear market rally. So we started out pretty normal, and we're looking at a pretty good spike there in the August range. Things were looking pretty good. There was some expectations that maybe the Fed wasn't going to raise rates as fast as they thought they would. But then inflation numbers, came in hot there in August, and we had the bear market rally fizzle out, if you will. To those of us who keep an eye on the markets, that was really no surprise. Nearly every bear market has come with a bear market rally or two in these situations. So no surprise there. Just not a very fun ride to be on in terms of the market there. So next we'll zoom out to the whole year. And unfortunately, the picture isn't much more attractive, but we look at the major indices on that last slide there. We included the bond market just because we wanted to show you that, a lot of folks look at the bond side of things as a safe haven, as buoyancy in your portfolio. but it really didn't provide a great place to hide this year as the Bloomberg aggregate was down, 12 or 13% on its own. You can see a lot of fear baked into the market in this chart. You're looking at a year where we've got a couple of pretty consistent bear markets, and you've got a lot of folks uncertain about what the economy is going to be moving into next year and how the Fed is going to try to tackle inflation, number one, but also their second mandate of maximum employment. So let's go to the next one and take a look at that headline that we mentioned, inflation. Some of you may be asking why we have three numbers on the chart for inflation, and that's because depending on which economists you talk to or which news source you're looking at, there's a few different ways to look at inflation. So we have the top line, which is what you call your headline CPI. That's your consumer price index. That's a price of a basket of things that you and I as consumers are going to go out there and spend our money on. And we see that year over year, those prices are up a little bit north of 8%. So we all pretty comfortable with that number. The middle one is your core inflation. So the academics and for some statistical reasons, they like to look at a number where you strip out the volatile food and energy costs. Now, I don't know too many people who go a day in their lives without consuming either food or energy or both. But for economic purposes, looking at the cost of goods minus those things has a little bit of value. So you'll see that lower number in the 6 range presented as a core CPI minus the food and energy. And that third one on the bottom there is what we call personal consumption expenditures. That one is a lesser known track, and that's one of the Fed's favored tools for measuring inflation. That not only looks at the prices of things, but it actually is a survey of households that shows what people are spending their money on. So you can understand the prices of things in CPI and understand what it would cost to go get those items. But the PCE is actually looking at, hey, what are actually people buying? Where's the money going? What are the costs of those things that people are actually buying? A lot of us do have a little bit of discretion in our budget as to what we do and don't buy month over month. So the Fed will pay close attention to that personal consumption expenditures. And it's a unique number. We'll get the latest numbers coming up here soon, but history shows us that those two top numbers tend to trend towards that bottom number, which is essentially what the Fed is looking for there. So the Fed and its tools, how does the Fed like to fight inflation? There's two main components to this. We'll dig into the Fed funds rate, which is their main tool and the one that all of us are pretty familiar with. It's the Federal Reserve benchmark rate, and that drives everything from your savings deposits, your CDs, to your car loans and your mortgages, and the interest rates that companies pay when they borrow money in the bond market to go out there and fund their businesses. So it's important to show that here this year we've had one of the steepest rate hike cycles in over 40 years, and that just means that historically, when the Fed changes the interest rate, they do it in very small increments. They're usually looking at what we say is 25 basis points per change, and that could be up or down. In this case, we've gotten all the way to 75 basis points for the last couple of hikes, and the market is pretty heavily favoring another 75-point rate hike coming up next week. The second anecdote to that is that historically, the Fed has not stopped raising its Fed funds rate until that Fed funds rate gets above the ongoing rate of inflation. So kind of back to the inflation chart, but when you look at, are we looking at 8%, 6%, or 4%, it's good to know that the Fed is looking at that personal consumption expenditures number. So we're approaching that neighborhood where the Fed funds rate is going to surpass their favored rate of inflation. And we may see signs of the Fed slowing down moving forward a little bit. One can only hope. The second item, and this gets a little bit more into the books, if you will, as far as economists and how money moves through the system, but we're all pretty well aware that the Fed has a balance sheet. So the Fed will create money. They will use that money to go out and buy assets in the market for various reasons. And when they buy those assets, that's called quantitative easing. They're taking financial assets out of the market and they're putting cash into it and letting the cash circulate through the market. So the opposite of quantitative easing is quantitative tightening. And there's two ways that that occurs. The first is a roll-up. And that just means that those assets that the Fed owns do have maturities. And when they mature, the Fed receives their due cash, just as if you and I had a bond or a CD that matured in 6 months. At that 6-month point, we would receive cash at maturity for the value of our bond. So the Fed is allowing that to happen. As their balance sheet starts to mature, they always have the option to take that cash and reinvest it in new securities, or let it roll off and hang on to that cash. That's effectively taking cash out of the financial system by letting it roll off. The second is what most consider to be a little more aggressive, and that's a sell-up. So that's basically where they say we have assets on the books worth X amount of dollars. We're going to go ahead in the market and sell those assets and take the cash that we can get for them and take that cash out of the system and put the financial instruments back into the financial system. So they each effectively take money out of the system. They reduce the money supply. They reduce liquidity, which for you and I, doesn't have a day-to-day impact, but for businesses and banks, that's very important. The banking system is built off of, reserve ratios and requirements and stress tests. So as liquidity tightens up, that affects the way banks are able to lend and do business and how much money they have to keep on books. So the next question is going to dive into these two tools that the Feds are using. Are they working? Are they effective tools at slowing the rate of inflation so the Fed can stop raising rates and causing pain in the housing market? And for us as consumers who need to borrow money. So how do you know if it's working or not? Well, one of the major looks is employment. We're at pretty historic lows for employment. We're in a 3.5% range for unemployment. So we still have a significant amount of job openings compared to folks looking for jobs. It's counterintuitive. Most of us as consumers would say, hey, that's a good thing. If people want to work, they can go out and get work at the moment, right? And that is a great thing. We want folks to be able to have gainful employment, but that does mean as consumers that the more people who have money in their pockets, the more people who are out there buying things day to day, they're driving up demand. And as we still see some supply chains unwind over the last couple of years, we're looking at prices remaining high. I don't know if anyone's gone out to dinner recently, but I have a family of 4, and the price has certainly gone up to go sit down and have a meal. And the quality isn't necessarily picking up along with the price. So you can look at some real world examples of feeling that inflation, and your dollar isn't going quite as far as it used to before. And the second look at that is going to be consumers, us as individuals. How much are we spending? And as a whole, as a nation, how much are we spending? We continue to set records for annual spending. And that has a lot to do with the money that's been pumped into the system over the last couple of years. In previous market updates, we've talked about the money supply and the stimulus from COVID and things of that nature. We're looking at consumers still having pretty strong balance sheets. There's still a lot of excess savings out there. So if folks have some things they want to buy or places they want to travel to, they typically have the cash to be able to do that. So those are a couple of quick measures on how you can judge whether the Fed is having an effect on inflation or not. I hate to say it for those who favor low unemployment, but to really see inflation come down, you're going to have to see unemployment get back to its historical norm of being in that 4 to 5% range. That's what most economists are actually going to consider to be a healthy rate. And we talked a little bit earlier about expectations. You know, the market has kind of built itself as far as analysts go and what you see on the news. We always have expectations of forward earnings, of economic growth, of um, cash flows, things of that nature. Anyone who's run a business understands that, you know, you start your year trying to project how you're going to operate and how you're going to produce cash flow and profit through the following year. And you'll even go 3, 5, 10 years out in some cases. So I wanted to show you a quick look at the S&P 500 earnings per share estimates. You're probably familiar with seeing the headlines of, you know, company ABC reports earnings that are above estimates, or they beat their earnings or beat earnings per share. And really all that means is that they reported numbers that were a little bit higher than most analysts thought they were going to be. So on the orange side of this graph is just the look at actual earnings per share. And you see that in most cases, you know, in the last couple of years, companies have beat their earnings expectations. And we see on the blue side moving forward, that's going to be our forward estimates of earnings per share. And that goes out through the middle of 2023. I thought that was very interesting that you hear the talk of recession and the state of the economy and, you know, when is a recession going to hit? Well, you know, the folks who run the companies of the S&P as a whole believe they're going to earn more money next year than they ever have in the past. You know, we have those two lines showing you the top there. You know, if we hit earnings expectations, these are going to be record earnings for the S&P. So I want to illustrate that as a contrast to the headlines and the narrative that you see out there that the world is ending and the economy is going to crumble, when there's plenty of jobs to be had and there's plenty of demand for goods and services. And the folks who are pretty good at forecasting their earnings, as you can see by the chart, you know, earnings don't typically get too far out of range of their forecast. They're still predicting, you know, all-time record earnings for the S&P. I will give you one caveat on this, though. The folks who produce their estimates have two goals. One, they want to be conservative. They want to set a low bar for themselves. So if they don't feel they're going to have a great quarter or a great 6 months, they'll say, we feel like earnings are going to be a little weak. They like to underpromise and overdeliver. So if they're setting a low bar for themselves to jump over, everyone loves what they call an earnings beat versus an earnings miss. So be aware of that even though these are record earnings, they are setting the bar a little low for themselves in terms of growth rates. But it's just interesting to see the calls that you hear and things on the news about the economy having trouble. The people who run these companies are still predicting pretty healthy years. They're still out there buying back shares of their own businesses, which is a key indicator that if they didn't feel these businesses were valuable long term, they wouldn't be, you know, spending that cash on buying back their own shares. So an interesting look at the folks who run the companies and where they think things are going over the next year at least. So looking at next week, so this is the chart on the left. This is a tool that you could all access yourself. It's called the CME Fed Watch tool. Is the chart you see on the left there. And really it takes the probability, what the market is predicting for the next Fed funds rate hike. So if that doesn't sound very interesting to any of you, I completely understand. That's our job here at CPS and for Brian and his team. But what it's showing you is basically the market predicts we're going to raise the Fed funds rate by 75 basis points. And that's going to put us in that range of about 4% for the federal funds rate moving forward. On the long run side, this is becoming a more and more popular graph that you'll see on the news. It's called the Fed dot plot. This is a survey of all the federal open market committee participants, so the key decision makers there, as to where they think rates are going to be over those different time frames. As those dots are concentrated in one area, it shows consensus. It shows a pretty good predictability that those rates are going to be in that window. So when we look at the end of 2022 and moving into 2023, we see 4.5% to 5%. There's a pretty good consensus there that the Fed participants believe rates are going to be in that 4 to 5% range. So what's that tell us? That means we have a hike next week, and it means we likely have another hike in December. The right side of that graph is very interesting. If you look at 2024, 25, and so on, you see that the plot starts to spread. There's not as much consensus as far as where rates are going to be in 2024 and 2025, and so on. Why is that? If we're pretty good at the next year and a half of rate predictions, why is there so much uncertainty for 2024 and beyond? I think that speaks to the narrative that a lot of folks feel like the Fed is going to overdo it. Historically, that is the case. They overcook it, if you will, and then they have to end up cutting rates to try to bring it back to where it's not hurting the economy, and they can spur economic growth with lowered interest rates. So that's an indicator of folks thinking that there's a possible recession at some point in 2023, early 2024. Some would tell you that we went through a recession here this year, but with unemployment numbers the way they look, it's hard to say there's a recession when there's still plenty of job openings. But I think it's interesting to get insight into what those federal open market committee folks are thinking, and even the folks who make the decisions can't quite see into the future. So that's a good thing to take away from that chart. So as always, CPS, we say steady as you grow. You want to have your capital in companies that have a proven history of management through these market cycles. They have durable products, things that are going to be used in good times and bad. I don't know about you folks, but in our household, just because the news tells us there's a recession, you don't stop buying your everyday goods. You're going to get your household goods. You're going to feed your families. You're going to put gas in your car. You're going to get up and go to work and live your life. Who can fault Warren Buffett when he says, be greedy when others are fearful? We showed you those charts up front about the market being down 20, 25, 30% in some cases this year. Translate that into fear. It doesn't mean the businesses in the market are worth 30% less than they were at the start of the year. It just means folks are fearful about what the future holds in the near term. A lot of that can be narrative building in the media. A lot of it can be a little bit of that uncertainty from folks who make those decisions. But in reality, businesses that we invest in are going to be here long term, that are well run, they have a history of providing capital back to their shareholders in the form of a dividend. If you've been with us before the start of the year through now, you'll notice that your portfolio is likely not down as much as some of those major indices. And that's where good companies really shine, is when the market goes down, the market shows their true value. They still say these companies are worth a little bit more than some of those companies that maybe aren't run as well, and maybe don't have those products that are absolutely necessary out there in the market. So again, appreciate everyone's time. I won't bore you with any more economics. We'll turn it back over to Brian, and I'll stick around for any questions at the end here. So appreciate it. Thank you, everyone.
Well, and thank you, Patrick, for that great insight. Having 2 college-age kids at home myself, I can certainly say that spending in my household will not be slowing down for the next couple of years, I'm afraid. Well, now I'm going to turn it over to Kenny Cray to talk about investing in uncertain times. Kenny, take it away.
Thank you, Brian, and thank you, Patrick. And I'm there with you, Brian. Spending is not slowing down at my house. So hey, look, we've jumped from unprecedented times into uncertain times. Now, I'll tell you what, I'm ready for some fun times. But we've got political turmoil going on. We've got midterm elections coming up, right? Who's going to control the House? Who's going to control the Senate? Rising interest rates. High inflation, war, and threats of war. And so now we're supposed to provide for our retirement down the road through investing. So how do we do that? You know, I'm going to get a bit geeky on you here for a second. One of my favorite iconic 80s films is Back to the Future. They just recently celebrated their national annual day of October 21st. In honor of Marty and Doc, let's jump in our DeLorean and go back in time, and let's look at history for a second. So here we've got the average S&P annual returns over the last 48 years. And we got a lot of black and we got some red on this. And I want us to focus on two sections, 1973 and 74, two big losses right there. And 2000 to 2002, some back-to-back losses throughout those years there. So it's kind of hard to look at percentages. So I'm going to put some dollar amounts in here that we can look at. Let's just say in 1972, right at the end of that year, we had $100,000 in the market. And so the very next year in 1973, that 100,000 would have gone down to $85,000. Now we might have said, okay, I can deal with some of that loss. Let's just hang on. And then we jump into 1974. Now our 100,000 is worth $62,000 roughly. So we might have decided to say, hey, this is enough. This is almost half of what I've got in the market, and jump out of it. Well, let's just say we didn't do that. And we had a decent plan in place. We had great trusted advisors giving us the confidence to stay within the market. So we stayed in the market. And now, not until about 1978 is when we finally saw we had $100,000 back in our retirement. So we keep trucking along because things are good, because it's been positive throughout these years. And then now all of a sudden we get to 1999 and we've got $3.3 million in our investment account. That's what it would have grown if we would have invested in the S&P over those years. And so now we hit 2000 and you know what? Our money goes down to $3 million and we say, well, got a great trusted advisor, stay in the market. 2001, now we're down to 2.6 million. Now we're getting a little bit worried because we've seen quite a bit of our investment in our retirement go down. And so we stick through it. And in 2002, it drops 22%. Now we're down to a little over $2 million. So we've seen our portfolio drop from 3.3 million by $1.3 million down to 2 million. So again, we've got our great trusted advisor telling us, hey, hang in the market. You know, history has shown it's always come back. And so we could have either jumped out at that time or hung in there. But let's just say we hung in there. When we got to 2020, we would have had about $12.8 million in our investment account. Now, I know the results aren't up here for 21 and 22, but 2021, the S&P 500 showed about a 28.7% increase. And so far here in 2022, we're looking north of a 22% loss. And so we're right on that cusp of saying, do we stay or should we go? And, you know, it's easy to kind of look back at history and play the armchair quarterback and say, oh, gosh, yes, I would have stayed through all of that because I'd have $12 million at the end of it. But those are real times, you know, in 73 and 74 and 2000 through 2002. And what we're looking at right now, we've seen our 401k drop significantly over this time. So how do we keep the emotions out of our investing decisions? Here's some ideas we can look at. So we buy companies and not headlines, right? So, you know, we all don't have to be economists. We can understand and know the companies that we're in and whether or not, even in down times when people are hard on money, are they still spending cash on these type of companies, right? These could be, you know, cell phones. Who's gonna depart from those these days? Could be our medications, toilet paper, or, you know, our goods, things like that that we need. So know what you're investing in and try to turn off the news as much as you can. They sell doom and gloom because that's what gets subscribers coming back. So stay away from that. You know, be an investor, not a trader. And the idea here is you're investing for the long term. You're not trying to time the market. it would be too ugly, because at times when we think we should be getting out are really times we should be getting in. And so don't do that. And there will always, so the one thing we've got to understand, there is always going to be a reason for us to not get in the market, to not buy. We can go back over history, right? 1999, we had the threat of Y2K, if you remember that, right? We thought all computers were going to shut down and we were not going to be able to function electronically. We went through 9/11, several wars, several natural disasters, subprime mortgages, which led to the banks failing and going through that global financial crisis, all the way through up to where our United States debt was downgraded, to Brexit, to various elections. There's always going to be an excuse. There's always going to be a reason for us to be scared to get in. What's important is this next one, is stick to your long-term plan. And so one of those things is to make sure you have a plan. But when you're sticking to your long-term plan, you kind of know what's going on. Revisit history, right? Jump in that DeLorean and go back and look and see what has occurred over the years, and work with a trusted advisor to help kind of talk you off the ledge, let you sit down on their couch and help you understand what's going on. Diversify and monitor your portfolio regularly are very important for you to have an understanding and knowledge of what's in your portfolio, what you're invested in. Because when you kind of know what you're invested in, you should have a level of comfort of knowing what's going on versus not knowing anything and just watching your balance decline. So stick with the plan, right? So the question is, do you have one? If you don't have one, I highly encourage you to work with a trusted advisor to get a plan going, right? And what this plan does, it's going to help you have that confidence to know, here is where I am today. Here is where I want to be in the future. And if I follow that plan or roadmap, if you will, here's how I get there. And just as life has a lot of changes, so will this plan. And that's when you're working with the trusted advisor, something comes up, you get an inheritance, your child is now going off to Ivy League versus the state, junior college you were hoping that you could afford. What do you do with these things and how do you manage those? When you have a plan, you can adjust and have the confidence of knowing you are on your way to meet the goals that you want to meet. So what is within the plan, or what is a plan? Here are a few things that you should consider. So one of the first things here, and we won't touch on all of these, but I'll touch on some of the important ones. Cash flow and budgeting, right? It's always a surprise. Usually me and my wife will sit down once a year and I'll call myself the CFO and I'll call her the CEO of our household, and we'll have a financial meeting and we'll lay out the budget for the year, and I'll go over, hey, here's where all of our spending went in the past, right? That was always a delicate conversation from there. But knowing, right, what we've spent in the past can help us adjust some of our decisions of what we move forward. So understanding how you're spending and what you're spending on is a great tool to have in your tool belt. And also an emergency fund. You never know what may come up in life. Do you have enough money set aside for when those emergencies hit? It could be a loss of a job. It could be needing to replace a car or having to replace a roof on the house. You never know what may happen. So when you work with a trusted advisor, this is one of those things that will kind of give you the confidence of knowing I've got enough cash to help me get through a tough time. Risk management and insurance, right? These are things that can be overlooked. We never want to look at the negatives of life. Or what if something were to happen to my spouse? What if something were to happen to me, whether it be a disability, whether it would be a loss of life? Do we have the right insurance in place that is not costing us too much, but it's going to protect us for what we may need, right? Working with an advisor will help you kind of define some of those objects and know those amounts so you're not overspending in there. Retirement planning and investment planning, right? These work together. I meet with so many people that retirement is more or less a concept. It's just a point in time that eventually you're going to reach, but they have no idea what that looks like. You should know what your retirement looks like, meaning you should know how much money you need to have at retirement. You should know how much you need to be saving starting today in order to meet that goal. And one of those goals may be, I want to retire when I get to a certain age. Well, if you're not talking about these things, if you're not planning for these things, it's kind of hard to get there, right? We've heard the term, those who fail to plan will plan to fail. I think when it comes to retirement, we don't want to fail in that area. Tax planning is a great tool. We're coming up on that time of year where this is something you should be looking at. You should be running tax estimates and projections to see, am I overpaying so much in taxes that I'm giving this kind of interest-free loan to the government so I can get a big refund come April, right? You could be utilizing that money to help pay down debt or to invest towards your retirement goals. So tax planning is a great time to do before year end here. Estate planning, this is probably one of the most overlooked items within someone's financial plan, right? And you'd be shocked to know how many people I ask, do you have a will, that don't have a will? And now you can get involved in some more in-depth estate planning, like whether or not you need a trust, whether or not your beneficiaries are correct. These are things that should be looked at and should be reviewed based upon your specific circumstance. And they should, if you have these plans set up, we always recommend at least every 5 years to have those reviewed to make sure they're in line with your current life events, right? Things change. If you've moved to a new state, chances are you need to get your will and trust updated according to those states' laws. Divorces happen, deaths happen, we have children, things change that we would want to make sure that if something were to happen to us, that we're not leaving an undue burden upon the next generation. And the rest there, charitable, education, and debt reduction. These are all things you can talk with a trusted advisor that planning can be done around to make sure that you can meet the goals that you want. So I can't emphasize enough, we are all not skilled in every area. But when you work with a trusted advisor who has the knowledge like Patrick on economics, or a financial advisor on these different plans from here, or a tax professional, this is going to give you the peace of mind when times are uncertain, that you've got a plan in place, that you've got that emergency red telephone that you can pick up and call that advisor and say, I'm scared. I don't know what's going on. Help me. Those things are priceless. So thank you for your time. I appreciate everyone attending. And Brian, back to you.
Great advice, Kenny, and thanks for sharing that with our audience. Thanks to you. Now I will have Doc's catchphrase of "Great Scott" stuck in my head for the rest of the day, and I can't think of two better words when it comes to the next topic we have to cover, with Don going over the situation related to taxes and the IRS. I know this is the moment that many of our audience members have been waiting for. So Don, what do you have?
Thank you, Brian, and hello, everyone. Wow, what a crazy couple years it's been dealing with the IRS. To say the IRS is behind, understaffed, and is a challenging, what a gross understatement that is. So let's look at what the IRS is doing to address these issues. Okay, call this IRS operations. The IRS is continuing to dig out from under its horrendous backlog of paper returns and correspondence. Now, we're continually seeing delays, service failures, and difficulties in dealing with the IRS. As of this presentation today, the IRS still has millions of returns and correspondence waiting to be processed. Just getting someone to pick up the phone at the IRS can take numerous attempts and requires you to be on hold for hours. And very frustratingly, you may be on the phone for a couple hours and then you get a courtesy disconnect and they have to call back and start all over. So if you do have to call the IRS, it's best to call them first thing in the morning and hopefully you'll get through. Now, as a reminder, we have a compliance department dedicated to IRS notices and issues resolution. The help may be coming, and this is what the IRS is doing to deal with this situation. So what are the plans of the IRS? It's coming in the form of the Inflation Reduction Act, which is 79.6 billion is appropriated to the IRS and related agencies, split among enforcement, operation support, taxpayer services, and business systems modernization. There's 87,000 IRS employees are to be hired over the next 10 years, and good luck finding that many new hires with the unemployment rate being so low. Here's the issue. Over 65,000 IRS employees are scheduled to retire during that same 10-year period. So if it's successful, the net hiring would put the IRS back at employment levels seen in the 90s. The big difference is the huge exit of experienced employees being replaced with inexperienced employees that continue to be understaffed. This upcoming tax season, this is what we can expect. We don't expect really any sweeping changes to the tax code unless midterm elections results are drastically different than expected. Many items, including the standard deduction and tax brackets, have been indexed for inflation. Here is the big one. Social Security Administration has just announced the largest Social Security wage-based limit increase ever, from $147,000 to $160,200 for 2023. This is an increase of $13,200 or 9% increase of the Social Security wage base limit. And this is to help cover the 8.3 cost of living adjustment just announced for Social Security recipients. So employers and employees will pay over $800 more in Social Security than they did in 2022. Next, we're going to talk about student loan forgiveness. Okay. If you're like me and have kids in college, I have one in college and one's graduated. It's time once again to start those FAFSA applications. For those with student loans, the promised student loan forgiveness appears to be taking shape somewhat. Student loan forgiveness applications formally opened on Monday, October 17th. However, actual loan forgiveness is not a guarantee just yet. There are several lawsuits pending that may stop the process. So for now, the forgiveness applications are simply a data gathering tool at this point. Now we'll keep an eye on the situation and let you know as things unfold. Okay. That's it for the IRS, what we consider for the upcoming tax season and for student loan forgiveness. Send it back to you, Brian.
Thank you, Don, for keeping us aware of what to expect from a tax perspective, my friend. We appreciate it. We hope you've found our presentation helpful so far. We have received a few questions both before and during this presentation that we'd like to address in our remaining time. If we don't get to your specific question, don't worry. We will reach out to you individually after the conclusion of today's webinar. So the first one I've got here, Patrick, it may be for you, my friend. The question is, what is rent and rental equivalence as it relates to the CPI?
Great question. And that is a large component of that headline CPI number. So they refer to it as owner's equivalent rent. And basically they survey homeowners and they come to a conclusion as to what you would have to pay to go and rent an equivalent home out there on the market at that given point in time. So pretty interesting number to track as far as, let's say you bought your home 10 years ago and you locked in a very low mortgage rate. If you tried to rent that same home out there, you're paying a heck of a lot more in rent than you are in your current mortgage payment. So it's that number tries to illustrate that component of CPI. I do want to point out the difference in the way those numbers are calculated, just as we talked about with that CPI slide. Owner's equivalent rent is 25% of the headline CPI number. But if you look at that Fed preferred personal consumption expenditures number, they only count that for 12% of that number. So they give it about a half weighting in the personal consumption expenditures. That at this point, that is a pretty big component as far as bringing that PCE number down. But long story short, it's just a way to track homeowners and how much they'd have to pay in rent to go get an equivalent home to what they own now.
Awesome, Patrick. Appreciate that information. Just a reminder as we go through these other questions, if you have a question that has come up during the presentation, please feel free to post that in our chat and we'll do our best to get to those. So I've got another question here, Don. I think I'm going to give this one to you. What is the status of the 2021 deadline extension for Florida residents?
Great question, Brian. The 2021 tax deadline for taxpayers in the state of Florida that would have been due after September 15th has been extended until February 15th due to Hurricane Ian. Now, we highly recommend any taxpayers that have not yet filed to get their tax returns completed and filed as soon as possible. Don't wait. Now, the deadline for filing the tax return has been extended, but payment for taxes was due back in April. So penalties and interest continue to accrue for any balances due. So you want to minimize any additional penalties and interest being accrued by filing as soon as possible and paying that balance. Second reason is the IRS has announced the e-filing system shutdown, which we call the blackout period, and it's going to start on November 26th. So from November 26th to sometime late in January 2023, the IRS will not be accepting any e-file returns. Back to you, Brian.
Great points there, Don. Yeah, if you think their backlog at the IRS is bad now, wait until you have to paper file that return after that November 26th cutoff date for e-filing. It will just put you in line. So we do strongly encourage that you get your information to us and let's get that return done this year before that November 26th filing or e-file shutdown. Patrick, I've got another one for you here. Sorry, man. Don't mean to pick on you. Should we be adding alternative investments, and the examples given are like gold or crypto, to our portfolios now that the market is down? What say you, Patrick?
So that is a great question, and a popular thing to reach for when the market is going south. You want to look for different things that are supposed to differentiate your portfolio. So I'll hit on each of those topics briefly. Gold, there's a couple ways to look at it. It's been around forever. It used to be a very big part of our monetary system. In reality, it's a tradable commodity. The use case for gold is very small in terms of jewelry, manufacturing, things of that nature. It's a commodity that's worth what someone else is willing to pay you for it. So the production value of the asset is very low, if you will. And historically, it is not a great hedge against inflation. There are periods where it can go up and down in value, but I'll take the stock market any day. If you have cash that you are trying to allocate now, I'm buying really, really productive, really great American companies on sale before I'm buying any hard metals or things of that nature. Crypto is an entirely different case. There's fair arguments on both sides of crypto, but if you look at crypto since its existence, it's fairly correlated with the stock market. If you were looking for it to protect you when the market went down, that simply did not happen in a year like this year. It's gone down even more than the market in a lot of time frames. So there's a lot of things that work out in the crypto space as to whether that area of the market is going to be a viable, productive part of our monetary system moving forward. So in the way we invest here at CPS, it's a little too unpredictable at the moment and too early stage for us to dive into. So not saying that there isn't potential. I think there's some various parts of it that have a lot of potential, but my retirement dollars won't be going to crypto anytime soon until a lot of those details are ironed out.
Yeah, kind of back to our stick with your plan motto as Kenny was going back. Speaking of Kenny, I'll change our slide here to one of my favorite pictures. And Kenny, the next question is for you. Are changes to the estate tax still an issue?
Oh man, what a great picture there. Yeah, so some of you may remember this. I know us in the tax planning and financial advising side of things, we were getting hit with a lot of questions in 2021 and a lot of fear. When Biden first came into office, he wanted to do a lot of revamping within the tax code. And one of those areas was the estate tax. Currently, right now, to give you some context, everybody can die with $12 million that can be passed on to their beneficiaries without being taxed. So this means a married couple, it would be 24 million. What Biden's plan was to bring that back down to pre-Trump levels, which would have been around, say, $6 million in there. So there was a lot of fear within there of saying, oh no, I'm going to lose $6 million of my wealth that I can pass on that may potentially be taxed at rates north of 40%. So what a lot of clients were trying to do before this law could get passed was to create a revocable trust, to start gifting some of their wealth to their beneficiaries now so they could utilize that $12 million. Well, long story short, COVID happened, wars happened, inflation happened, rising gas prices happened. So President Biden had a lot more on his hands than revamping the tax law. So that did not go into place. However, the original law that was put in place by President Trump, where we're at $12 million now, is geared to sunset at December 31st, 2025, which means the rates are going to go back to previous of his term, adjusted with inflation, which would come out to, somewhere between $6 and $7 million in 2026. So if you have a large net worth, you may own a lot of highly appreciated assets, such as real estate or businesses or family farms, that your net worth may be north of 12 million as an individual or 24 million as a married couple, you might want to start thinking about some planning items that can happen over the next 2 years. Now, a lot can change. A lot of this is driven on, who's in presidency, who controls the House, who controls the Senate as to where these are. But it's a great thought process to have in your head now, but no immediate decisions need to be made now. But again, having a plan, speaking with a trusted advisor so you're aware of these things and you can put action in place before you're caught off guard and all of a sudden you've got an estate tax issue.
Thanks, Kenny. Great news to share with us. We appreciate that. One final question that we have, and I think I'll take this one. What's going on with the employee retention credit? Wow, we're getting this every day. So the employee retention credit, if you're a business owner or if you are a sole proprietor and you own your own business, you have probably been inundated with emails from these national consulting groups about the employee retention credit and how you can apply for thousands upon thousands of dollars related to those people that you employed during the pandemic. The employee retention credit was meant to help us through the pandemic, to keep people employed, to keep businesses from letting people go and putting them on the unemployment rolls. But it's one of those adages that if it sounds too good to be true, it probably is. We have seen many examples where these credits are not being calculated properly. The IRS has been notified and is now involved. There are over 11,000 claims with over $2 trillion that the IRS is currently looking into for fraud. And so we expect this is going to pan out over the next 5 years. I believe that's the statute of limitations as it currently stands. If they find enough fraud, they may even extend that. So if you have questions or if you're receiving those emails about the employee retention credit, talk to us, please, because the last thing you want to do is find yourself on the wrong end of the stick with the IRS should that calculation that you provide not end up being accurate, and then you have to go back, repay not only the credit given, but also penalties and interest, which can be substantial. Well, we're wrapping up for today's presentation. Of course, I've got to give the required disclosures, talking about what we've gone through today. It's meant to be some comprehensive data, but it doesn't cover your situation entirely. So if you have questions, please reach out to us. Let us see how we can be of help. And when it comes to accomplishing your financial goals. And last but not least, thank you. As always, we appreciate your time and attendance at our quarterly economic update and hope you found a few pieces of information from today's presentation to be helpful or at least thought-provoking. A copy of this presentation will be posted to our YouTube channel within the next few days and may be included in any thank you emails sent out to our audience. As a reminder, our next quarterly update is scheduled for mid-January, and be looking in your email for that invitation to arrive in the next couple of months. And don't forget to check out our website and blog posts for the latest information on various topics. We hope to see you again at our next scheduled event. Please take care.